Well, good afternoon and welcome to the Investment Committee Best Practices webinar hosted by Catholic Investment Services. Thank you for joining us today. My name is Tom Lanctot and I'm privileged to serve as the Chief Executive Officer of Catholic Investment Services. Joining me is my colleague Zela Astarjan, who's done a great job organizing this program and is at the Zoom control panel. Enormous thanks to our all-star panel who will be introduced shortly. Today's format will be conversational with CIS board member Paul Stevens acting as moderator. There will be plenty of time for questions, so please use the Q&A feature on your Zoom screen to submit a question. We also recommend that you use the gallery view on your Zoom screen. But again, please use the Q&A feature, not the chat feature on your Zoom screen to submit a question. Everyone other than our panelists will be muted, and the call is being recorded. Services was founded by some of the investment industry's most respected leaders to address the investment challenges faced by Catholic organizations. We are a Catholic nonprofit serving other Catholic nonprofits and hope that this webinar provides some useful take-home value. Zela provided some biographical information concerning our panel, but I can't help but add a few further thoughts. Our moderator, Paul Stevens, is a trustee of Catholic Investment Services, but more importantly, is what served for many years as the investment committee chair for the Diocese of Arlington, Virginia, and he continues to serve as on investment committees for several noteworthy Catholic organizations. Before his distinguished career at the Investment Company Institute and in private law practice, Paul served in senior positions in the White House and Department of Defense during the Reagan and Bush administrations and received the Department of Defense's Morrison and his firm Asset Strategy Consultants serve a number of Catholic clients and have an unparalleled reputation for independence and integrity. We at CIS appreciate the constructive and thoughtful way that Al engages with our common clients. Tom Skiba, in addition to chairing the investment committee for the Diocese of Fort Wayne South Bend, is, like so many of you on the call, a real community leader. While recently retired from a successful career in public accounting, Tom seems to be working just as hard pro bono as he did during his professional life. Tom is a lifelong learner and a real student of investment committee best practices. Thanks again to our exceptional panel for contributing your time, talent, and experience today. Having now really worn out my welcome, I'm pleased to turn the call over to Paul Stevens.
Tom, thank you very much. And I thought it would be appropriate for us to begin with a prayer. For this purpose, I've actually selected the well-known Serenity prayer that was authored by Reinhold Niebuhr that seems particularly appropriate in this period of the COVID-19 pandemic. So we'll start in the name of the Father, and the Son, and the Holy Spirit. Amen. God, grant me the serenity to accept the things I cannot change, courage to change the things I can, and the wisdom to know the difference. Living one day at a time, enjoying one day at a time, accepting hardship as the pathway to peace, taking as he did this sinful world as it is, not as I would have it, trusting that he will make all things right if I surrender to his will, that I may be reasonably happy in this life and supremely happy with him forever in the next. Amen.
Amen.
In the name of the Father, and the Son, and the Holy Spirit. Amen. Well, thank you all for joining us. It's a real privilege to be invited to moderate this session and to be with Tom Skiba and Al Morrison in talking about investment committee practices. You know, I think you start with the proposition, of course, that the church has temporal goods for a purpose. And canonically, there are four different purposes that these goods serve. They support divine worship. They support our clergy and other ministers. They support a wide variety of Catholic apostolates. And they support works of charity, especially towards the poor and the needy. And under canon law, investment of money is a key part of the duties of those charged with stewardship of the temporal goods of the church and of other religious institutes and societies. Long-term investments, of course, are part of the patrimony of our church. And canon law also emphasizes the need for transparency and accountability as important elements of stewardship in this and other regards. So in the conversation which we will have, we really thought that 4 areas are of special importance. We'll begin with how to build and structure an effective investment committee. Secondly, we'll talk about some of the processes, the procedures that an effective committee would observe, including the process for creating an investment policy statement. We'll talk about investment partnerships and the role of the consultant. This is a role that Al Morrison has served in for so very many years. And then we'll conclude by considering best practices around management and mitigation of potential conflicts of interest. So we've all been on many committees. We've found some more effective than others. I think an investment committee has an intimate relationship with the organization of which it's a part. So Tom, where do you begin in terms of thinking about how to structure an effective committee?
Well, I think you've touched on what I learned when I was a partner with Ernst & Young. You look at people, process, and technology. And let's start with the people part. So, you know, if I want to be involved with an investment committee and I'm the chairman of the committee, we're really looking for people with the time, the experience, and the willingness to participate. I think you touched on the fact you really have to understand the organization, how it works, and what its mission is. I think that's critically important. Our diocese, we're over 80 parishes, many schools, 4 high schools, lots of affiliated organizations, including a foundation. So you have to understand the organization. You know, I'm a CPA, and so I quickly look at what is the financial condition of the diocese, what is its operating results, and what its cash flow needs are. We also then look to what do we invest? We invest with Catholic Investment Services, not only our operating investments, the long-term portion, but our pension assets, as well as the assets in the foundation, or those primarily endowed assets. So you really have to understand the background of the organization. I think the word that when you talk about people is really committed. It's a really time-consuming engagement. I expect people to do their homework, read the information, be prepared for the meetings, you know, to determine strategy for the organization. And, you know, I like a very diverse committee. I like people who are both have investment backgrounds. I like an accountant who can also talk about how it reflects in the financial statements, how they're valued. I like the fact we have some legal folks on our committee who can understand things like ERISA for benefit plans, understand a MIFA, if you will, and on proper conduct of investing. Governance comes into play. I expect everyone to read the guidelines of the diocesan financial guidelines. It's the U.S. Conference of Bishops, and they have some guidelines. You know, again, they're looking, you hit upon it. We're faithful stewards of the investable assets, and we're supposed to be prudent. We're supposed to be investing following the socially responsible guidelines. I know we're going to touch upon that a little bit later. You know, how do we get people? Really, a number of different ways. Some people are recommended to us. We seek some people out, and some people just volunteer for the organization. You know, we're very blessed in our diocese, where we have some Catholic universities like Notre Dame who have often supplied people to our committees. We have other Catholic colleges and universities. We have some Catholic health systems that we can tap on, and some religious orders. They have really provided a bunch of people for membership on our committees. We're blessed with having some Catholic leaders of healthcare, financial services, a couple of people who then were also chairman of healthcare systems. One of our members is a member of the Federal Reserve Bank of Chicago. So it's really an ongoing process with retirement, people aging, passing away, unfortunately. Again, we're constantly looking for members for those organizations.
You know, Tom, there seems to be a movement now, more broadly in terms of governance, about thinking about limitations in terms of tenure in a board position. And I think that a period of service and then rotating off, but perhaps doing so on a staggered basis so there's continuity, you don't lose the institutional memory, is probably characteristic of an effective committee structure. Would you agree with that?
I would. Again, I worked with public companies as well as large nonprofits in my career. I think that is a benefit. Again, you don't want to lose that institutional knowledge. They could remain on committees, in an emeritus status or involved in other aspects of the diocese. You don't want to lose their involvement, but some rotation is good. And it's the size of the committee. I've heard varying reports, 5, 6, up to 10. I'm not so hung up on the number of members. Again, people can't always make our 4 quarterly meetings. Again, the number of people is not a big deal for me. But, again, I philosophically agree with you in terms of staggered terms.
And what about the characteristics of an effective chair?
I think that's a great question. Again, as I reflect on what I do, again, I don't know if I'm a cheerleader, but I keep the committee in a positive direction. We disseminate information. We have 4 meetings of the year. I think critically important is developing an agenda. It's not just me. It's from the management of the diocese. It's from our investment advisors. And what do we want to talk about? Now, some are routine things. We always want to approve minutes. I think that's very important. We want to document our discussions, the decisions we make, to preserve those, the things we have decided as we go forward. Other things we develop, and Al's going to talk about investment policy statement. That's critically important in terms of decision-making, hiring and firing managers and evaluating performance. Those are things that we always have on our agenda. But an interesting thing we always do is we always leave room for continuing education. We've had a number of talks assisted by Catholic Investment Services. We've talked about hedge funds. We talked about investing in China recently. Most recently, we talked about private equity. How has that aspect of investing performed in the last 10 years? Striving for the best managers that are out there. So, we always leave room for that as part of our agenda, if you will.
There's one last characteristic, and we'll move on. I think I found to be very important as I served as chair of our committee in 2007, 2008, and 2009 during the extraordinarily wild ride in the stock market that saw the portfolio really bottom. And I think that is an ability to remain calm even when the markets are most volatile and stick with the program.
I was trying to think of a good word for that. Whether you call it grit, fortitude, or everything. Again, we developed, because what I was talking about, our long-term investments, is really our investment strategy. And it's a long-term, whether it be the financial crisis a decade ago or the virus today. You can't let those short-term blips impact your long-term thinking. And I've had members who say, why aren't we totally equity when the market was hot? Why do we have so much equity when the market's not? Again, you develop a strategy, as Al will talk about, and you stick to it through, again, I think if we would have panicked, we would have lost money because of the pandemic. And now here, markets have restored themselves. So you're right, you got to stick to, it's tough, but you really have to stick to that long-term strategy.
And especially since the investment horizon of the church is either infinite or it's tomorrow. We don't know when the second coming is going to be. So you've got to kind of stick with the program. But let me move on, Al,
Sure.
to you. And you've seen so many investment committees, both religiously affiliated and otherwise at work. And I thought maybe you could talk for a few minutes about what you found to be effective procedures, and in particular, the importance of the investment policy statement.
Paul, thanks, and my pleasure. Few just thoughts, and Tom and Paul, you've covered a lot of what I'll call the attributes of a successful investment committee. We are going to talk about the investment policy next, which really is the cornerstone of sound governance. And it's a document that has the full input from all the constituents, starting with the board, investment committee, internal staff, the consultant. And it's the opportunity to really put into one document all the necessary input on long-term goals, objectives, and I'll get into more detail on some of the manager and performance monitoring. But the more time is put in up front, more input from all the constituencies we found historically, you end up with a document that reflects not only the organization, but also the diverse group of committee members. I don't know if Tom mentioned the ideal number, at least from all we read and probably have experienced over the years, between 5 to 9. You want to have
Agree with that.
a solid group that, as you said, Tom, they come prepared. They're there for the right reasons. I always like committees where the egos are left at the door. We're all there on behalf of this Catholic institution. No one has to prove how smart they are. And the leadership, again, the chair is the key, but also staff. You have some organizations where the chief investment officer in many cases, which we find is a key component, that internal staff that really is an important part of the organization. And maybe the final comment, this need to plan for succession, that committee members, some of Paul's comments on limiting terms, that you want to have in a pipeline type of individual who's going to come in next, bringing those junior members that can spend maybe the first year more in the learning curve, but then evolve into being more engaged in the day-to-day committee meetings.
So Al, you've always emphasized the role of the investment policy statement in governance, and it's a document that I think you would agree probably needs to be reviewed at least once a year. It should be kind of a living document, and it's the touchstone, I suppose, if you will, the handshake that you have with whatever the governing body is of the Catholic organization that the investment committee is serving. Perhaps you can elaborate a bit on its role.
Sure, and again, very critical document, and it is one document that is constant. We have turnover in committees, we have turnover in staff, but this document certainly is the broad governance of how this portfolio is going to operate, starting with all the goals, objectives, down through the performance monitoring, controlling costs. So again, something we find every time a new committee member comes on board, this is the first document they should read as they're getting prepared to join the committee. You're right, annually, ideally, it should be put on the agenda. We tend to do that the first meeting of every new calendar year. That aligns also with updated asset allocation studies we do every year to look at forward returns and levels of volatility for the portfolio. Ideal time to have every committee member go back through and just see if there's anything that they want to question for discussion. And at the end of the day, this document certainly is the end product of the input, as I mentioned, from all the constituents, and will really provide that foundation for going forward. What I might do is, for the sake of time, run through what I'll call the major components in an investment policy statement that tend to be very critical to the oversight, and certainly starts with a well thought out description of the organization. What are the goals and objectives? And I'll expand upon that more when we get into spending policy, the bishop's guidelines, all the components that set the stage for how we're going to build the portfolio, how we're going to monitor. So very important to lay that out in the first section. We always find helpful for all the constituents to have a section that outlines responsibilities, starting with the board, down at the investment committee, to staff, who have certainly involvement with some interaction with the custodian and money managers. And so the consultant has a big role to play, just with information, data, experience over the years of dealing with committees and trying to find that effective document that works best for each organization. The big issue, I think, for today's talk certainly is getting into the spending policy. And this is what sets the stage for how we invest. And for our audience today, certainly the bishop guidelines that have an impact on the separate account managers that will be put in place that can enforce the restrictions that might be coming through on the investment policy statement. And the typical spending policy, we always try to keep this a fairly simple analysis, starts with what are the liquidity or spending needs. Just for discussion purposes, we use that standard 5%. Some organizations are lowering it to acknowledge the market's going to be a lot more challenging for the next 10 years than the 10 years behind us. These are intergenerational dollars. You want to maintain your purchasing power. So we have to factor in what's inflation for We use 10-year forward timeline to run these documents. So we come up with that magical 7%, which I think we find is a number that's fairly common amongst the endowment foundation organizations. And from that point, we want to address how do we invest to achieve that 7% with the least amount of volatility. And this gets into the asset allocation process. Step one there traditionally is with the committee, what asset classes are we comfortable investing in? Do we want to be in hedge funds, high yield, et cetera? At the end of the day, you have an approved list that's in the IPS. And then we run optimization to look at what's the most efficient mix to meet that 7% with the least amount of risk. So a big step that sets in motion then the next phase, which are procedures to retain managers and to go out to the full universe, look at as broad a demographic database as you can. And we're looking to retain managers in equity, fixed income, domestic, international, in each one of the approved asset classes. And to do that with some focus on how much volatility, how much risk are we going to expose the portfolio to, and ask that hard question. To make that 7%, can we live with a standard deviation that in down markets could bring us into some red ink, certainly, and some areas we prefer not to be in. And then
of course, this whole process, Al, does it not? You're describing something that would be characteristic of many Catholic organizations, but I think one aspect of an effective committee is recognizing the nature of the organization you're serving. For example, a diocese or an archdiocese may have considerable resources to support a more elaborate and complex investment process. They also may have a much larger portfolio that you could begin asset diversification by manager. Others are going to be much smaller and won't have much in the way of resources at all. So the process has got to be very sensitive, I think, to the context, does it not?
Now, very good point, Paul. You're correct, because you certainly have to be customizing everything based upon assets available, in some cases the expertise on the committee. And we don't want to be in a world where you have cookie cutter and you have portfolio A, B, and C. You have to start with the organization liquidity needs, their ability to withstand some illiquidity on the alts. So it is a case by case, and this concept of the IPS being developed with the consultant and the committee and the board does tend to lead to a very specific focus on the uniqueness of each one of these clients and the assets that are so dear to them to be properly managed for the future.
You know, one thing that shouldn't change, in my view at least, is the compliance with the U.S. Conference of Catholic Bishops investing guidelines. And I've been surprised when I've spoken to members of investment committees for some church organizations that don't adhere to those. But Tom, maybe you can talk about the importance of that just in terms of investing the church's dollars.
Well, you know, again, if you read those guidelines in the diocesan financial management, we're supposed to be good stewards. We're supposed to be prudent and also be cognizant and invest in socially responsible investing. We in the Fort Wayne South Bend Diocese hold that in very high regard. And with Catholic services, investment services, we're approaching in the high 90s or 100%. So we value that very significantly in terms of socially responsible investing. The question I often get is, do you get, you know, how do you compare to others who are investing? You know, we have found over our time and in my history with clients that socially responsible investing will earn just as much, if not more, over the long run. So again, you're not losing yield by doing the right thing and following those guidelines, if you will. So
I think what you are doing, though, is avoiding the possibilities of scandal. I know that the bishop whom I served was very, very sensitive to the idea of the church's dollars being invested in ways that would be morally offensive to church principles,
right.
to our morals, and that would add to scandals at a time when, frankly, our church does not need any more of those.
True. Now, I would put a different spin on it, saying when I'm involved with the Catholic Community Foundation of Northeast Indiana, again, surveys have shown that people who invest in our foundation want to be invested in socially responsible. It's a very high percentage. In fact, all of our marketing materials, one of the first things we say is, it's Catholic people doing Catholic causes, but we are socially responsible in our investing, and we get very positive feedback relative to that approach that we've taken. So again, there's a positive spin as well as avoiding the negative.
Al, I want to turn to you now, because the third of our topics is the potential contributions of a consultant. Perhaps you can talk about that role. I particularly admire the way that you approach it, because you bring a degree of independence to the discussion and data that's always very helpful.
Thanks for the compliment. We always take that. And I thought I might start this with just a brief discussion of the two primary models, and one, this recent growth in the OCIO, or outsourced chief investment officer, where you're giving full discretion to the consultant to make all investment decisions, is certainly evolving, part with the market volatility. So there's more and more organizations questioning, is that the right format for our organization? And then the majority of organizations we deal with, it is a non-discretionary, where our role is to support the committee, and the committee has the final vote on all changes in the portfolio, manager selection, et cetera. But to get to the consultant's role once we're retained, it certainly is to evolve, and I use this term respectfully, to be the trusted advisor. That's something you have to earn over the years with organizations, and interacting with the board, more so obviously with the investment committee, the staff, and it has to be a very interactive team orientation, where we're all trying to achieve those same long-term goals. We find that we do end up being an intermediary in coordinating a lot of activity between the organization, the money managers, the custodian, do a lot of hand-holding on back office paperwork functions, manager agreements, just being helpful to reduce that workload on internal staff. And something I have found is very, very helpful, and this is, again, looking at the importance of the chair of the committee, is time we spend before the meeting. We'll have a certain number of pre-calls where we'll have the material in advance. I think Paul has been through this with us, where we can ensure we're all focusing on the same key issues, no surprises, and just be prepared to maximize the use at the quarterly meeting. Many times, whether you have 45 minutes, an hour, the clock is always ticking. So time and prioritizing is certainly critical. And we find these pre-calls allows us to agree with the chair of the committee. Sometimes we'll have the senior staff member in that conversation. So we have actionable items that we want to make sure to get covered and prioritize the flow of the meeting in that way. I think the other key thing that is the key to consulting, and it's just what I'll call depth of resources, all the analytical tools that a consultant needs, certainly, but also the committee is a beneficiary of asset allocation studies, databases on managers, when you're doing searches, certainly the reporting process where we're looking for accountability, attribution on what happened with the total portfolio versus a peer universe, and also a customized benchmark looking at the passive indices that align with the asset allocation targets, and to use that data and in dialogue, the interactive conversation to reach informed decisions. I think that's one way we describe the end result for all the work that goes into it, is to make good, sound decisions predicated on facts, data, not get into the emotional side and behavioral finance, but keep it according to hard information and focus on longer term. We find it's important to cover what happened for the quarter, but we're not going to make a lot of huge decisions over a bad quarter. It's a long-term performance that we want to focus on and make adjustments based upon manager issues and any changes that might be coming out of the annual analysis of the investment policy statement that might change the allocation targets.
You know, Al, I think the point you make is really excellent. And if you think about the importance of the investment committee looking long-term, I think getting that data on a quarterly basis and having a track record and an understanding of performance over over an entire business cycle, if you will, or market cycle, can be very, very helpful. It not only sort of helps you, score your own report card, but I think it's also critical in the dialogue that you have with the bishop or the head of the organization in terms of how the investment committee is doing. And so that's an element of accountability that's very helpful for the committee.
No, good point, Paul, because certainly accountability is the right term. We want to benchmark ourselves, the consultant, obviously, but also the investment committee. So when we look at a money manager and everyone is in a defined asset class, let's just use international equity as an example. So we'll benchmark them against that peer universe of other international managers so we can see how they stack up against other firms that could have been retained for the mandate. And then we want to see, are they outperforming the appropriate passive index, particularly when we have actively managed managers and we're paying the fees for that. Are they producing the sufficient returns where you get value over and above what the passive solution could have done for you? And it's very important to look at that, and the numbers don't lie. I think the other issue, which is always interesting with committees and also with consultants, is what I'll call expectations, that every manager that is considered has an historic footprint. There'll be market cycles where their style will excel and you expect them to do well in those cycles. And then they'll have the flip side where the market goes against their style and they're going to tend to struggle. A good example would be a defensive manager that doesn't take excessive risk when you get big momentum markets like we saw in 2009, 13, 18. Structurally, you're not going to win the game, and no one likes underperformance, but they're there to be more defensive. And we always ask that question first, someone who has underperformed for a year or so, do they perform as we expected? And if the answer is yes, because of their buy-sell discipline, and we will be a little more patient, get away from that behavioral finance of something is broken, we have to fix it. And we all know the story of the manager you're fired and you hire somebody else to look good. And guess what? 6 months later, the market rotates and the guy you fired all of a sudden is back top of the heap. So it's, again, using data information to make good, sound, long-term decisions.
Yeah, value managers are used to these conversations by now, I think.
They certainly are. They're in a bunker mentality, but at some point, and history tells us that it will turn. But this has been an unusual 10-year cycle with growth dominating and big momentum markets we've been in.
Let's turn to our final subject then before we take the questions. I hope that our audience will pose questions. We're happy to address them. But that's managing and mitigating conflicts of interest. And I think that's always a risk for church organizations, including investment committees. Tom, you've confronted, I'm sure, circumstances that needed to be addressed along those lines. What's your wisdom about how a committee manages that?
I think that's a great question. Again, I'll follow the USCCB guidelines that talks about avoiding conflicts of interest and self-dealing. You know, we follow the traditional nonprofit rule in the fact that every member signs annually we have a conflict of interest statement. Annually, you sign the statement attesting to what you're involved in, and you have no conflicts with that. So again, that's just a mechanical thing that you see in 990s and everything else. But you know, again, I guess it's the word transparency. In the last decade, I've seen more and more transparency with an organization or a nonprofit with its stakeholders, including its donors. And so, you know, again, being open, you know, again, we tell people who we invest with, and we avoid conflicts of interest. There's no self-dealing. Catholic Investment Service is a great solution for us. I'm constantly bombarded, as well as management, saying, hey, we'd like to invest your funds. Well, are you socially responsible investing? And those kind of things. So, you know, again, it's something we have to address all the time. The CFO of our diocese would say he gets calls every day from vendors, particularly investment side. That's how we do it. Again, we're very cognizant of it. Again, I think you'll see Notre Dame. They just say, I don't have people on my board, you know, where I invest. So they just did a hard and fast rule. So you can do whatever you want. Again, it's something we monitor. And again, it's the prudent person, you know, again, taking care of the diocese money, being socially responsible with our investing.
Yeah, and there's only one reason at the end of the day why anyone should be on an investment committee, and that's to advance the missions of our church. It's as simple as that. It's not for self-aggrandizement. It's not to promote some other business opportunities. It's not a condition of your philanthropy or your generosity to the church. It's service to the church's mission, whatever it may be in the context of that organization. And it's actually kind of a humbling responsibility at the end of the day, as I know you appreciate. Well, Tom, we're at about almost 20 minutes of the hour, so I thought perhaps we could begin to take some questions if there are some from the panelists, from the participants.
Oh, we have some great questions coming in. Let me start with the first one. And by the way, thank you for this fascinating discussion. Love the conflict of interest section. First question, is it better to have an outside person as chair of the investment committee? Currently, we have a staff member serve that function, but they do not vote. Paul, do you want to?
Well, I mean, I do think it's useful to reach out to expertise beyond that which resides within the organization. And I think, as Tom mentioned earlier, a diverse talent pool, which includes both people from within the organization and outside the organization, can be very helpful. I don't know if I would say that that's a hard and fast rule, but I think principles of governance, modern principles of governance, more and more are looking for a kind of independent view to be enlisted into the governance process. And so I guess my inclination would be to think recruit from outside for that role. But Tom, you may have a different view.
I have the same feeling that really you want to recruit from the outside. We certainly have management people or internal folks attend our meeting and add their input. I guess I go back to when I work with public companies. You know, with the SEC, it's kind of insistent that you will have outside people. You will have experts on your audit committee, your investment committees, et cetera. So, you know, they take it to the greater extreme. I agree with you that, you know, your chairman, as well as a number of members, a majority of members, I'll even say, should be from the outside.
Right. Next question. How do you evaluate your consultant and how frequently? Paul, I think this question is for you.
Well, it's a very good question. I mean, I think in some sense the process of evaluating a consultant is ongoing. You know, it's not a subject that you sort of put away and return to. You know, I think the consultants got to be proactive. I said that an independent view is very important. Keeping to the timetables of the committee, anticipating the needs of the committee as it meets, being responsive to the concerns, availability to meet with the bishop or the head of the Catholic organization that the committee is serving would be very important. And I think that there is a benefit of if the consultant is earning it, of an ongoing relationship, because it gets you up a learning curve, I think, and then sustains a very high level of quality support. Now that assumes that the consulting organization is managing its own succession planning and things of that nature, which is obviously critically important. Al, how often should you have your committees evaluate your performance?
That's a very insightful question. Certainly from a governance practice, you do see a pattern of whether it's every 5 years or 7 years, at least look. Just don't get too complacent. A good consultant certainly should continually be able to provide the accountability, the rationale why they should be continued, but it never hurts to check the market. The process can be frustrating when you're the incumbent, but we certainly understand and appreciate the organization has to do what's right for the oversight of the assets. And it helps us, I think, in some cases to ensure we're covering all of our areas of responsibility, which we certainly do meet internally to review that at the end of every quarter on what happened with each client relationship. So you have to be very interactive. And I've also found over the years, something that we all enjoy is once you understand the mission of an organization and how those dollars are being spent, it becomes a live, you get emotionally attached. It's not just producing numbers and providing all the assistance that people need, but to really get an appreciation for how important these dollars are and some pride in being part of a team that is overseeing.
Thank you. Thank you, Al. Some great questions coming in. Next one, what would you recommend if the investment committee and CFO are on opposites regarding investments, for instance, equities or not equities? I would say maybe Paul, you want to start, and maybe Al next.
Well, that's an interesting question. To me, the modern portfolio theory is such that there's a pretty clear path forward in terms of assembling an appropriate investment portfolio. And it would be an unusual organization, I think, that would say, well, we don't want any equity exposure. There would have to be a very compelling reason, in my view, if these are long-term investments, long-term assets that you're talking about, particularly in the current marketplace where fixed income is producing so very little. You will not, with a fixed income portfolio today, reach 7% under any circumstances. And you certainly won't achieve 7% on top of inflation. So, I mean, I think the circumstance as described really requires an extended discussion and an understanding of what might underlie that conflict, if you will, of views. And then ultimately, and in my way of thinking, in a diocesan organization, for example, that's something you take to the local ordinary. The bishop needs, at the end of the day, to be the one deciding an issue of that sort. But it's very clear in my own mind that constructing the portfolio is, and put the more exotic assets aside, a fairly straightforward proposition. Tom, Al, I don't know if you agree with that.
I agree wholeheartedly. Again, our process, I didn't go back to that, is after we have our investment committee meeting, we then have lunch and meet with the bishop. So we quickly involve him in that process and the decision-making things we've reached. Over time, he's really, listened to a variety of advisors and people on our committees. And again, it's that portfolio you were talking about. Why wouldn't you be in equities? I'm not sure I'll be Notre Dame and be, everything to equities or, alternative investments. But, a nice balanced mix makes perfect sense. You're going to look at the underlying need, but I'd be surprised if again, if you're long-term investing, you have to be in at least a good part of it, 2/3, whatever, in equity. So I would agree with that.
So Paul, a couple of thoughts that, because this is an interesting question. This is a reality of a committee, but part of it is the diversity that you want to have at 5 to 9 membership, and you're going to have difference of opinion, and that should be encouraged. Most people will speak up with their thoughts, and the group as a whole has to assess each sides of the conversation and come up with an informed course of action. And Tom and Paul both said this, that at a point where there's impasse, you go back to, we develop this investment policy statement for these goals, objectives. Have those goals and objectives changed? If not, we still need over the long haul to make that magical 7%. At times we'll get into a discussion, particularly in the current market environment, is just to go through the charts and graphs of markets, go through their cycles. They've historically always recovered. You get a peak, you get a valley, another peak. The hard part is the timeline between that valley and peak. The markets do recover, and we've all seen the stats of if you overreact and pull away, the market turns, and if you miss that first 20, 30 market days, you really diminish your opportunity to capture that upside on the rebound. So it's always best to stay the long term unless something's changed internally with cash flow needs, or I think we're seeing some of those discussions now with the COVID that, some of the academic institutions we deal with trying to figure out their balance sheet for the fall, and they're looking at that endowment as a spot they might have to come for a larger one-time take just to facilitate keeping the things in the balance in the budget.
Yeah, there's, you know, some people might think of the fixed income investment as de-risking the portfolio, but there's also a risk if you think about the long-term health, financial health of the organization in not accepting some of the risks and the rewards that equity markets afford you. So Zella, shall we go on?
Yes, we have several more questions. Next one. Are there investment policy templates available, and does the investment policy specify the vendors or asset allocations? Before I turn this over to you guys, I would like to say that we have prepared an ebook on investment committee best practices that we are going to share with all participants and registrants on Friday. And we have a nice section on that about all of this. Paul, Al, Tom, what would you like to add on?
Tom, you want to take that one?
I was going to give it to Al, but you know,
Al, Mike, yeah,
there's plenty of templates out there. You know, again, you know, as a CPA, the AICPA has an investment policy statement. That's a good example. If they're interested, they can say, you know, I would be glad to provide it. It's very well written. Your investment advisors have plenty of policies. Anybody who sells investments has them. You know, again, the GuideStar has some examples. BoardSource has some examples. There's plenty of templates out there, and I'd be happy to provide several. I've got a little stack of them I provided for others.
The important thing is after you find a template to customize it to your own
Exactly,
organization.
right. If you want the outline in words and here's how, you know, the things you should be thinking about, but customization is really the key to your particular situation.
Next question. How do you assure independence of your consultant, and how do you measure success?
Well, you know, in my own concept of that, the question really is, what is the consultant providing to the organization? If it's both providing advice as well as investment solutions and products that are proprietary to it, then I think that there's an issue that those two could be potentially in conflict. So if they're simply providing, as asset strategy consultants do and others, a tool to assist the committee in analyzing the performance and effectiveness of its managers or its investment solutions, then I think there's an alignment of interests there. That's how I think of it. Tom, do you have any comment?
You know, I would agree with that. You know, again, we benefit by having some of our Notre Dame folks on our committee. And so they have a huge, you know, they have 70 people, you know, investing in across the world. So they have given us a number of metrics. They've evaluated a lot of products already. But I like what you said, and that is, you know, what's my yield? What's my earning? I want to avoid self-dealing. You know, are those products, you know, containing huge fees? And I'm a geek a little bit. I read the underlying prospectuses. I read, you know, the 990 for Catholic Investment Services. So I want to pierce that, again, to avoid self-dealing and conflict of interest.
I also would hope that a good consultant would be looking across the range of potential investment solutions for its client, and not simply wed to whatever happens to be on its platform or an affiliate's platform, which is essentially a commercial relationship that it has and maintains in the market. So that is another issue I think that you have to be alive to.
Okay. Next question. Do you feel a separate investment committee is needed with an endowment of approximately $10 million, or do you feel that the finance committee can handle those responsibilities?
You know, it's interesting to think about small amounts of money in Catholic organizations. Very often, in my experience, the fact that the portfolio is small does not mean it's less important. In fact, it can mean that it's altogether more important. I've been involved with some Catholic organizations with portfolios even smaller than that you're citing there, Zella, and I think they've benefited from having the assistance of an investment committee in managing those assets and helping them deal with developments in the marketplace. So I don't think that's too small a portfolio to organize an appropriate investment committee process around. Al, I see you shaking your head. I hope you agree with that.
100%, Paul. And you had the magic term there. Every dollar is important to that $10 million endowment or institution. We shouldn't be worried about how many zeros are on the end. And you can have a very nicely diversified portfolio. You can have a committee that might not have a lot of Wall Street experience, but still follow good best practices and have the ability to compete in the marketplace with those larger multi-million-dollar portfolios that might have more resources. But you can do very, very well with a group that's dedicated to the entity particularly. And there's a lot of folks in the foundation world, nonprofit world, that they might not have a lot of financial background, but they are very, very dedicated to that nonprofit and their mission, and they're there to help it be successful. So.
Great. There are two more questions. I'm going to try and fit it in before the 3 o'clock time slot. Do the panelists, the first one, do the panelists have any guidance on how best to explore the USCCB's SRI guidelines of adding exposures to positive strategies, which include investments that promote community development? This would be in addition to the doing no harm and active corporate participation. So I guess this question is, it's all about SRI investing versus impact investing is the way I see it.
Tom, let me pitch that one to you.
I share what we had talked about, over time here a little bit. I think I look at SRI investing and covering the whole blanket, whether it's, microloans, whether it's, other types of investments. Really, do you follow the guidelines? It's the AKA green book, if you will, by the bishop. Are you following those guidelines? Does it make sense? Impact investing. Well, I have to look at what the returns are too. We propose that to our bishop, saying, they may have higher risk, they do good for society. We may be able to do some of that, what are the returns on that? But, socially responsible is socially responsible investing in my mind.
But I do think, Zella, that more and more Catholic organizations are trying to figure that out. And I think there are more and more investment advisors, managers who are trying to figure that out as well. So the market seems to be moving in that direction, and I suspect there'll be more solutions coming to market and available to Catholic organizations.
Especially with Laudato Si, there's a lot of good information and push from the Pope. Okay, next question. How large does your endowment need to be before hiring a consultant? I think that's a great question. Maybe Al, this question is for you. And I think there are various consultants with various minimums. I forget what your minimum is. Maybe you can talk about that.
And a good question. And I think part of this is you have to factor in, if you hire a consultant, whether they're charging you 10 basis points, 15, or it's a flat fee, which is becoming more and more common, what is the added value that they're going to bring to the table as far as the portfolio being more competitive in the marketplace, not just on performance, but looking at the risk metrics. And the challenge certainly is for larger, consulting firms. It's difficult when you get down below 10 million to not price yourself out of the market, particularly with this open architecture platform that independent RIAs focus on, where the only remuneration comes from the client. There's no trails, there's nothing out of the product side. It could be an opportunity for some of this outsourcing for small. I think in this OCIO market, that is one solution where it can be beneficial. Paul, you might have some insight to this also from your travels.
Well, it's a very, very good question, and I think, Al, you've laid out some of the factors that need to be considered. But I mean, I think that price is obviously going to be very, very important, and what the resources within the organization there are that in the absence of a consultant can do an appropriate job of monitoring the investments and just tracking how well the portfolio is doing. The one thing would be very concerned about as a member of an investment committee is that the committee should not have operational responsibilities, in my view. I don't think it's practical. I don't think it's an appropriate role. You need to think of the committee as governance, and then the committee needs tools and support in order to do its work. And the right kind of consulting arrangement can, in the absence of similar resources within the Catholic organization, be a real help in doing that, if you can get it, and if the price is right. Tom, I don't know, do you have a?
No, I agree with you wholeheartedly. You know, I was looking at size of Catholic foundations across the country, and there's 181 of them. You know, the average is probably in the $30–40 million range, and we've created 41 new ones. And most of those will go with the investment advisors at that range. But can I afford it? We had investment advisors for a historic theater, and you know, we only had $4 or $5 million in investments. We thought it was worthwhile because we didn't have those internal resources to invest on our own.
I would like to add that we're a perfect fit for those smaller organizations because we pool everyone's assets from various Catholic institutions to give access to some great managers. So anyway, next and last question, because really we're very close to the 3 o'clock mark. How long should you monitor a manager under performance before termination?
Well, there's a tough question. Al, what's your answer?
So let's start. The IPS certainly is going to have language on what are the procedures to monitor managers. Sometimes you have a watch list concept. That's part of it. Manager performance, there's 2 components. There's the qualitative side, which are the people, the process, where things can happen overnight. Good example, you have a great mutual fund. There's a single PM. He retires, gets bought away. When he walks out the door, all those performance numbers go with him. There you might have an immediate termination. Normally in an investment policy statement, you want to look at 3- and 5-year performance, not get buried with the noise in the shorter time period. I'll come back to my comments earlier on every manager we hire. We have an expectation of when they might falter using historical data. So we go through our checklist when a manager goes onto that watch list for 3 years as an example. And that's the first question. Do they behave as we thought? Or maybe I should back up. The first question gets in anything qualitatively that might be problematic. And then we look at if they behaved as we thought, even though they didn't perform well. We're certainly going to have an attribution study. We'll sit down with the committee and point out the rationale. Our recommendation normally is to stay the course. And again, use data, use history, and take the emotion out of the equation.
I don't think you can be too quick on the trigger, though. That's the important thing. You have to give the manager an opportunity to prove what it's capable of. And if over a longer term it remains problematical, I think it's then that the committee needs to seriously consider a change. I don't know that there's any particular window that I would ascribe to that. And sometimes it's relative performance, isn't it, Al? It's not. They may just be beating the market, and a bad market not just doing quite as bad as others.
Correct.
But this is obviously part of the discipline that the committee brings to bear over an extended period of time on behalf of the organization.
You know, one final comment on that, if we have time, and this is something that certainly our Diocese of Arlington that did always very well when Paul was involved, is on the retention side, interview the managers. Get some face-to-face time. The consultant's doing that with site visits, so we get to spend a lot of time with the teams. But you learn a lot just by that 30, 45 minutes with the individuals from that firm. Then if a firm does falter and it's the committee's getting anxious, we found it very helpful to invite that manager back in to plead their case in front of the court. And many times that does seem to calm people down, particularly when we get into the market cycle they're in, and takes a little more time, but we find you get better long-term results, less turnover by investing that time up front and then being gracious with those managers who are working as hard as they can, but the market just might be a bit out of sync with how they're allocating, et cetera.
Yeah, just as a final comment, I can't tell you how valuable I found it to be to sit with the manager's team at the time that they were being engaged and periodically thereafter, to be able to hear how their investment program is going, the issues that have been raised, the management of their firm and all the rest of it. I thought it was a key aspect of the due diligence and fiduciary responsibilities that the committee has. So Zella, we're 2 minutes over time, so shall we bring it to a close there?
I think we will conclude. So thanks again to our great panel for a very valuable program. Special thanks to our audience for joining us today. And in the coming days, as Zela mentioned, we'll be following up to share a copy of our new ebook on investment strategy. And please be healthy and safe. And this concludes our program. Thank you very much for joining us.
Thank you all.